Hi guys, sorry about that. I thought you were in the wrong session. I thought we should have been in the previous session, but I see everyone is here. I think this is the right spot, so we are going to stay here. All right, so please hold a moment as I pull up my slides. Okay, recording. All right, now we're all together. Very good. Good morning, everyone. So we are going to continue with chapter 17 today, and then we're going to go through the PowerPoints, and then we will be doing the homework for chapter 17 as well. After chapter 17, we have one more chapter, which is chapter 20, and we'll be starting on that maybe if we have some time today later on. Okay, so hope everyone had a good Thanksgiving. Hope everyone is healthy, happy, and ready. We have about 3 more sessions after today before the final. So it's a time, remember, to start slowly getting together everything that we've been reviewing over the semester. Remember that the final is cumulative. Okay, and is going to consist, I believe, of 50 multiple choice questions. It's a 2-hour final. The date is posted on Blackboard, and it'll be consisting of about 50 multiple choice questions. Again, just like we had on the midterms, some will be theoretical in nature, and some will be calculations. So just make sure that you have a calculator handy with you at that point. In terms of our Apple investment, when we met last Tuesday, actually, it took quite a dip. It was trading at about $113.52. I just looked a moment ago, and we've actually seen a surge in the Apple stock, and it's trading at $122.66. Okay, so it's gone up about $9 plus some change, which is interesting. Now there's a little bit more stability in the market. People are getting a little bit less tentative. They have a plan for getting the vaccines out. So it's had a positive on the overall stock market generally as well, particularly for Apple. And if you know, I'm sure we've all discussed, you all have Apple products, you know that typically December is a month where Apple has the majority of its sales, actually, because of the holidays, etc. So this tends to be a boom month for Apple. Okay. So again, in this chapter, we were basically talking about job order costing systems. Okay, remember that when we discuss job order cost systems, we are still going to be talking about manufacturing. Okay, but now we're talking about when the manufacturer actually completes unique jobs. Each job that they actually perform for their customers, clients, are unique in nature. Okay, and also remember that even a service company, such as a CPA firm, a doctor, etc., a service firm can use a job order costing system as well, in addition to a manufacturer who's actually manufacturing a product to sell to their customers. Okay, and then Joshua, I see you have a problem. Is the problem? This final is going to be made by me, and it's going to be on McGraw-Hill as well. Yes. Manpreet, I don't know offhand. I posted it on Blackboard Connect. Okay, you could see in the announcements section. Okay, and it's a 2-hour period. Very good. Thank you. So just keep that in mind, and it will be on McGraw-Hill. All right. Okay, so job order cost systems used by when someone is performing unique jobs for their customers. And again, it becomes so important because they have to know how much, remember the 3 product costs, how much of the 3 product costs actually have been transferred into the final product, such as how much direct labor, direct material, and manufacturing overhead. Okay, now again, as a manufacturer or service provider is basically providing services or goods to their customers, Remember that at month end, they must make an adjusting journal entry. Okay, and the first adjusting journal entry, again, it's going to be at least once a month. It could be more often. It depends on the firm. Okay, but at least at month end, all the materials that are used during the month are totaled, and the following summary journal entry is made. Okay, so for direct materials that are placed into production, you're going to see a debit to the work in process inventory account and a credit to the materials inventory account. Okay, remember, just as a bit of a review, if we're looking on the balance sheet of a manufacturer, how many inventory accounts are going to appear on the balance sheet of a manufacturer? Who remembers? 3. Excellent. Daniel, Christian, Francisco, very good. Remember, if it's just a merchandiser, it's 1 inventory account because they're only purchasing and selling finished goods. A manufacturer, however, is going to have 3 inventory accounts that appear. And we see 2 of them here, the materials inventory account and the work in process inventory account. So here we see the journal entry for transferring the costs from the materials inventory into the work in process inventory account. Okay. Then this, the second journal entry that we're going to see is for direct labor. Okay, and then again, because this is such a unique situation, remember that when we have the direct labor general ledger, okay, remember it is going to be basically debited for all the payroll costs. Okay, and again, that's direct labor payroll. And then as those costs are applied to specific jobs, that's when we're going to see the direct labor general ledger being credited. Okay, and that's what we see here in this journal entry. At the end of this month, again, and at the end of every month, a summary journal entry is made which debits the work in process inventory, again, increasing the work in process inventory, and crediting the direct labor account, the direct labor journal entry, general ledger account. Okay, and all this is doing is applying these direct labor costs to the work in process inventory account. Okay. Okay, and here for this particular for this particular account, it's for the oak and glass production departments where you're seeing this journal entry. Okay, so that's the second summary journal entry that you'd see. Okay, and then remember there's also going to be a third summary journal entry, and that's going to be the third product cost, which is for manufacturing overhead. Okay, that again, we've talked about, we go through, from just as a reminder, when we're dealing with manufacturers in the factory, that's where the product costs are incurred. Okay, so basically you're going to go through the checklist in your mind. First of all, is this cost incurred in a factory? Okay, if not, okay, then this type of cost is going to be transferred. It's going to be debited and reported in the general and selling and administrative section of the income statement. However, if it is incurred in the factory, okay, the first question you ask yourself, is this cost a direct material cost? If not, then is this cost a direct labor cost? If not, then it is going to be a manufacturing overhead account. Okay, so that's a catch-all. And remember, manufacturing overhead is typically the largest of the 3 product costs that get charged to the work in process inventory. Okay, remember, overhead also is an indirect cost. We know direct materials and direct labor, since they are traceable to the final product, you can actually see or count, see on time cards, etc., how much of the direct costs are being charged to each job. The only one you really can't trace directly is overhead. Okay, and that's why we have to come up with, remember at the beginning of this chapter, we were talking about the predetermined overhead rate, the POHR, which is that overhead rate that is established at the beginning of the year, okay? And how do we determine what the overhead rate is going to be at the beginning of the year? Okay, the production managers, the CEO, the CFO, they're all going to get together and they're going to determine what the estimated manufacturing overhead is going to be for this year. Okay, then they're going to divide by some type of estimated cost driver. Okay, and again, typically it's going to be the estimated cost driver. Remember, it must have a direct correlation as to how the manufacturing overhead costs are going to actually be incurred. Okay, and then what happens? We get a per unit cost. Okay, based on this fraction, we get a per unit cost for the estimated cost driver. Okay, and then as that cost driver is incurred during the actual year, that's how the manufacturing overhead is then going to be charged to the jobs. Okay, so that's how we'll move forward from there. We're going to go over a lot of instances of this, so we'll see again. Okay, but that's basically what we dealt with in this chapter. All right, so here we see now we're going to apply the third product cost in that summary journal entry at month end. Okay, so Oaken Glass uses an overhead application rate equal to 150% of their direct labor cost. So right away, okay, when you see this sentence, that means that this 150%, that is the POHR, or the predetermined overhead rate that was established at the beginning of this year. And remember, a different predetermined overhead rate is going to be established at the beginning of every year. Okay, and then what else do we know from this? We know that the direct labor cost is the cost driver. Okay, this company, Oaken Glass, believes that as direct labor costs are charged to the job or direct labor costs are incurred, okay, that is the way that there is a correlation between the direct labor costs incurred and the manufacturing overhead costs that are incurred. Okay, there's a direct correlation. So that's how they're going to apply the manufacturing overhead to the jobs based on the direct labor cost. Okay, so therefore each job cost sheet is going to be charged with overhead equal to 150% of the direct labor cost, okay, relating to this job. So in this particular instance that we're seeing here, okay, we see that direct labor cost for this month, okay, and again, this is the control account, okay, not the subsidiary ledger, which tells you what every single individual job is. This here is just a control account. We see that $60,000 of direct labor costs were incurred on the jobs being performed during this month. Okay, and remember, this is actual direct labor costs for this month. Okay, so actual direct labor costs equals $60,000. We multiply it by the actual direct labor cost by the predetermined overhead rate, and that will then tell us for this month what the amount of manufacturing overhead applied is going to be, which here equals $90,000. Okay, so here we see now we're transferring the cost, we're applying the cost from the manufacturing overhead account, and we're applying $90,000. So we debit the work in process inventory account, and we credit the manufacturing overhead account for the $90,000. Okay, and here we're going to discuss this now in a little detail again. When we have the manufacturing overhead general ledger, okay, remember that actual manufacturing overhead costs are going to be debited. And Dante, is manufacturing overhead applied to just jobs? Yes. They have to be applied just like direct labor and direct materials. Manufacturing overhead is going to be applied to the individual jobs. Okay, here though, when we have this, like the summary journal entry, this just tells us basically for the control account. Okay, I'll go back and I'll show you in a minute, Dante, to answer your question. Remember, this $90,000 is being debited for the work in process inventory for several jobs. Okay, so this is just the control account that tells you in total how much manufacturing overhead is applied, okay, to all the jobs that were basically being worked on this month. Okay, and then we're going to have a subsidiary ledgers also. And the subsidiary ledgers will tell you how this $90,000 was divided up among all the different jobs. Okay, and the same thing for the direct materials and the direct labor. Okay, you have a summary journal entry, but then you also have detailed journal entries to the subsidiary ledger. Okay, and good question. I'll show you that. I'll go back to that in a moment. Okay. But here now, just for the manufacturing overhead, remember it is debited for actual overhead costs, like indirect labor, indirect materials, depreciation, any factory costs that are not direct materials or direct labor. Okay, then over the course of the year, remember that this manufacturing overhead has to be applied. Okay, this manufacturing overhead has to be applied to the work in process inventory account, and this is how that happens. Okay, and here for this particular company, Oaken Glass, they decided to use direct labor cost as their driver. Actual direct labor cost is their driver. Okay, and that determines how much the manufacturing overhead they apply. All right, everybody's good with this? All right, let me just see where that summary journal entry is for 90,000. Okay, no. All right, so let me go back here, Dante, just so everybody can see. Again, what we just went over here. So here, see how, the $90,000. So see how we applied $90,000 of a manufacturing overhead we credited manufacturing overhead, and then we debited the work in process inventory account. Okay, here for that $90,000. In addition, again, that was the summary journal entry. That tells you in total. Okay, but in addition, what are you going to see? You're also going to see for the manufacturing overhead, you're going to see how much has been applied to every single job. Okay, so this is again, so here, remember, let's go back to summary journal entry for direct labor. When we applied the $60,000 of direct labor to the work in process inventory, this is all the jobs. And we also have a subsidiary general ledger that tells you on a job-by-job basis how much direct labor was applied. Okay, which jobs. So you have it in total, but just like for inventory, remember we have the subsidiary ledger, you're also going to have the detail, because you have to know for your job cost sheets, you have to know how much of the product costs are applied to each job. Okay, same thing for direct materials. Remember, we just credited in the summary journal entry, we credited direct materials for $50,000, and we debited that cost. We transferred that cost to the work in process inventory. That $50,000 is broken down in the subsidiary ledger between these three different jobs that were being worked on for this particular month. Okay, so the journal entries we just did, and typically we will just be doing the summary journal entries. Just realize though, in real life, just having a total like that is not sufficient. You have to have a subsidiary ledger with the details as well. Okay, and now here for the third product cost, which is manufacturing overhead of $90,000. Remember, we just did, that was the last summary journal entry we made. Okay, which jobs did that manufacturing overhead get applied to? It should be here, manufacturing overhead. There should be a beginning balance, no. Work in process, okay. So here the manufacturing overhead, how much manufacturing overhead was applied to job number 830? Okay, we see that $36,000 of manufacturing overhead was applied this month to job 830. Okay, we also see $30,000 of overhead being applied, of manufacturing overhead being applied to job 831. Okay, and then finally we see $24,000 of manufacturing overhead being applied to job number 832. And those three amounts that are added together for manufacturing overhead in the subsidiary ledger, that is going to total the $90,000. Okay, that was debited in the summary journal entry. Okay, so just realize you have the control accounts here, but you also have to, a manufacturer also has to maintain the balances on a job by job basis, and that's what the job order cost sheet actually provides. Okay, the job order cost sheets are you're going to see these particular amounts being charged to the job order cost sheets. And then once the jobs are completed, and only when the jobs are completed, that's when you'll see here job number 830. Once it's completed, the total costs equal $90,000. That's when the finished goods inventory is debited for $90,000, and work in process gets credited. Okay, here for job number 831, when this job is completed, you credit the work in process inventory for that amount and debit the finished goods inventory for $75,000. Okay, same thing when the job is completed for a job number 822. Okay, so that's how you see the. So Dante, does that answer your question? So yes, manufacturing overhead as well as direct labor and direct materials do get charged to the jobs. Okay, and that's basically going to be in the general ledger, the control account, and in the subsidiary ledger as well. Okay, and then you have these are the summary journal entries we just went through. Okay, and now what happens? We know, okay, I had mentioned that at year end, okay, oh, you're welcome. At year end, we have this manufacturing overhead account. Okay, and this is what we're dealing with the control account with the totals. All right, so we've been debiting all the actual costs, all the actual manufacturing overhead costs to this account over the course of the year. Okay, and then we've been applying that overhead to the specific jobs and to the total work in process inventory over the course of the year. Okay, remember though that when we apply this overhead, we use the predetermined overhead rate. Remember that rate that we established at the beginning of the year? Remember, that's only an estimate. That's what we thought our manufacturing overhead was going to be. It is not unusual though. In fact, it almost always happens that you're going to have a balance at the end of the year in this manufacturing overhead account. Okay, you may either have a debit balance, okay, or you're going to have a credit balance. Okay, either way, regardless of what your balance is at the end of the year, this manufacturing overhead account is going to have to be zeroed out. Okay, and when you as of 12/31, all right, at the end of 12/31, when you're getting your books ready, okay, and you close all of your temporary accounts. Remember that from Accounting 101. Okay, after you close all your temporary accounts, this manufacturing overhead account is going to have to equal zero. Okay, because it has to have a zero balance, because what's going to have to happen starting 1/1 of the next year, all of the manufacturing overhead costs are going to have to be debited to this account and then credited and applied to all the jobs in the next year. Okay, so remember that predetermined overhead account, the predetermined overhead rate that you establish at the beginning of the year is an estimate. So you're always going to have variances at the end of the year. It's rare when your actual overhead to the dollar is going to match the amount of your applied overhead. Okay, so if you have a debit balance, okay, if at year end you have a debit balance in your manufacturing overhead account, okay, what does it mean? It means your actual manufacturing overhead was greater than the amount that you applied. Okay, that means your actual manufacturing overhead is greater than your applied. Okay, that's why you have a debit balance. Actual is greater than applied. Okay, now you have to zero out that balance, right? As I just mentioned, you have to end up with a zero balance in the manufacturing overhead account at the end of the year. So to basically zero out the balance, if it has a debit balance, okay, what you're going to have to do, that means that you, if it has a debit balance, okay, if your manufacturing overhead account has a debit balance, that means that you under applied overhead this year. Okay, you under applied overhead. That means your jobs were costed a little bit too low. Okay, because the actual manufacturing overhead was higher than what you estimated. Okay, so what are you going to do? You're going to have to do a journal entry at year end. Okay, if it's under applied, and what are you going to have to do? You're going to have to debit your cost of goods sold for the amount of that under applied overhead, and then what are you going to credit in order to make that manufacturing overhead account balance equal zero? You're going to have to then credit your manufacturing overhead account for that amount. Okay, because remember, the debit balance was too high. It was greater than the amount of applied overhead. So here, you're just going to have to reverse out that balance, the debit balance, so you would apply. And again, if it's not material, okay, if it's not a material variance, then you're just going to charge it to cost of goods sold. Okay, and therefore, what do you do when you debit cost of goods sold? You know that you're going to increase your cost of goods sold. Okay, now what else could happen at the end of this year is that there's not a debit balance in this account, but there is a credit balance. And what does that mean? That means the credits are greater than the debits. Okay, so if the credits are greater than the debits, that means overhead was over applied. You applied too much overhead to your jobs. Okay, then that is the cost of your jobs is too high. All right, the actual amount of overhead was less than what you applied to your jobs. That's why you have a credit balance. So again, you have to zero out the balance in your manufacturing overhead account. If it's not a significant or a material difference, what are you going to do? What would be the journal entry at year end? You would just do the opposite. You would just debit the manufacturing overhead. Okay, when you debit the manufacturing overhead, it makes the debits here equal. It makes the debits and the credits now equal. So the balance is zero in your manufacturing overhead account. And then what else would you do? You would just credit your cost of goods sold. And when you credit cost of goods sold, what are you doing? Are you increasing it or decreasing it when you credit your cost of goods sold? Are you increasing it or decreasing it? Credit cost of goods sold. Remember, cost of goods sold is an expense. So very good, Daniel. Kristen, when you credit the cost of goods sold, you're decreasing it. Because remember, you over applied overhead. Your jobs are costed too high. So when you credit cost of goods sold, you're decreasing it. Very good. Okay. Now remember, it could happen. Okay, it could happen to, let's say, a manufacturer that at the end of the year they see that the variance that they have in the manufacturing overhead account, it's a significant variance. Okay, either the debits are too much higher, the debits to the manufacturing overhead account are much higher, or the credits to the manufacturing overhead account is much higher. What could that mean if the balance is significant? Okay, let's think about this. If the balance is significant at the end of the year in this manufacturing overhead account, remember, we have to zero it out, okay? It could be a sign that there's a problem, okay? It could be there's a sign there's a problem in your accounting system or in your costing system if the balance at the end of the year is material. Okay, what do you think it could mean? Maybe it means that the cost driver that you have been using, that is here when we were using direct labor costs, it may be an indication that direct labor costs are no longer would no longer be considered a good cost driver for manufacturing overhead. Okay, so excellent question, Francisco. What would be considered to be material? Typically, that's going to be a decision that each company is going to have to make individually. Typically, it runs about 1 or 2%, above what the actual costs are. Okay, but for our purposes, like on an exam or problems, you would always be told whether it's material or immaterial. Okay, but a good sign that your cost driver is not a good driver is when you start to have material differences at the end of the year. Okay, and that's why a lot of companies, which we're going to look at a little bit at the end of this chapter, that's why companies basically started to look at ABC costing. Activity-based costing. They stopped using the typical drivers that had been used in the past, like direct labor hours, direct units produced, etc. And they looked for more innovative type of cost drivers for their manufacturing overhead. Okay. All right, but if it's if you're told that the amount of the variance is not material, and it usually will be for our purposes, you could just transfer that cost to the cost of goods sold. Okay. And if it were, since you asked, Francisco, if it were material, you would have to charge the amount of that variance to all 3 inventory accounts, the work in process, the finished goods, and the material overhead, and direct materials. I'm sorry, work in process, finished goods, and the cost of goods sold. You would transfer that material. You would have to divide that material difference between those 3 accounts. Okay. You're welcome. And that's what you're going to spend, again, for those accounting majors, you spend a whole semester just on that. Okay, so, and again, it's not unusual. Okay, so again, here, assuming that the amount of under or over applied overhead for the year is immaterial, which, as I just showed you, you're just going to just transfer that close that account to the cost of goods sold, either adjusting it, either debiting it or crediting it for the immaterial difference. However, if the difference is material, and you would have to be told if it's material, you would have to divide that material difference between the work in process inventory, the finished goods inventory, and the cost of goods sold. Okay. And remember, when companies are dealing in a global competitive environment, again, the whole purpose of doing this type of cost accounting is to understand how costs work, okay, and to control the cost. So if you start seeing these material variances, that's good. That's usually a sign of trouble, okay, in your costing systems. Okay, so here let's take an example. So let's say you're the treasurer of this company and they are a manufacturer of industrial lasers. Among your responsibilities, you supervise the preparation of the company's tax returns. Okay, so the treasurer tells you that there has been a significantly large and material amount of under-applied overhead, okay, among the work in process, and it's been divided. Now, again, when manufacturing overhead is under-applied, what does that mean? That means that the actual costs are greater. Okay, if it's under-applied, that means the actual manufacturing overhead costs are greater than the amount that is, the actual manufacturing costs are greater than the applied amounts. Okay, so your jobs, okay, that you have completed for this year, okay, are basically charged too low based on the manufacturing overhead that should be applied to those accounts. So actual manufacturing overhead costs are greater than the applied. Okay, so what they've been doing is that they're just dividing it among the work in process, the finished goods, and the cost of goods sold account. Now, what the assistant says you should start doing is just charging, instead of dividing it among the 3 inventory accounts, you should just take that amount, that total amount of the variance, and just debit it to cost of goods sold. Okay, now why would you do that? Because it's going to raise your cost of goods sold, increasing it, okay, which is an expense, okay, and then you're just going to, if your expenses are higher, then your expenses are higher, your net income is going to be lower, and your taxes are going to be lower as well. Okay, but again, when you have a problem like this, when material differences start consistently occurring in your books, in your accounts at year end, that signals an underlying problem. Okay, and it also means that if the actual manufacturing overhead costs are greater than what's being charged to the jobs, that means your job cost sheets, okay, the expenses, the overhead expenses charged to your job cost sheets are too low, okay? And realize then that you may be charging your customers too little, okay? You're not accurately reflecting what the costs on the specific jobs are, okay? So you're going to be charging your customers too little, okay, for the work that you're doing for them, and that's going to reduce the amount of your net income as well. Okay, so realize you can't just bury accounting problems like this, like here, don't just charge it, instead of dividing the material difference among the accounts, among the 3 different account balance sheet and income statement accounts, just bury it in cost of goods sold. Okay, that's not a long-term solution when there's an underlying problem. Okay, so that's why here that suggestion that you just charge it to cost of goods sold is not a good recommendation. Okay, and it's not a good solution, because it's showing you that there's other problems that are ongoing in this company, and they could actually go out of business if they're not going to be able to generate profits in the future over the long term. Okay, and again, they may have to look, if you're ending up with big variances like this in your manufacturing overhead account, you're going to have to change possibly what the driver of your costs are. Okay, if you have been using total direct labor cost, maybe that's not an appropriate driver anymore for you. And you're gonna, and it's a big effort that you're gonna have to do to change that cost driver, but it could be basically be a determinant of whether your company is going to stay in business or not. It's that important. Okay. All right. Now, again, remember when the job is completed. Okay, this particular job is now completed. What happens? Remember, the costs related to that job have to be transferred from the work in process inventory account into the finished goods inventory account. Okay, so here, as each job is completed, the job cost sheet is removed from the work in process subsidiary ledger, and they're going to be debited, and the cost sheets are going to be entered onto the cost of goods manufactured. Okay, so here this is taken from the work in process and the finished goods inventory. So during January, Oak and Glass completed work on these 2 jobs. All right, number 830 and 831, when they completed work, the total amount of those jobs, okay, the total amount of the costs that had been transferred into the work in process inventory is now going to be credited or removed from the work in process inventory and debited to the finished goods inventory. So that means that job number 830 cost $90,000 to complete, and cost job number 831 cost $75,000 to complete. Okay, so you debit the finished goods inventory and credit the work in process inventory, and this information would also be appearing on the job cost sheets as well, in addition to the control account on the general ledger. Okay, so you always have to do that transfer between the inventory, the work in process inventory, reducing it and transferring the related cost of the jobs to the finished goods inventory. Okay, and then remember, only when those jobs then are sold, Okay, when you actually send them, ship them to your customer, that is when you can now record the sale. And then when you record the sale, you're also going to adjust your inventory accounts as well as your cost of goods sold. Okay, so here, as the sales of the finished goods occur, you're going to use the unit cost, okay, the amount per unit. So here, the sale of 40 of the dining room tables at a total cost of $48,000. Remember, that's the sales price. So here we're using a perpetual inventory system. So remember, when you use a perpetual inventory system, there's two different journal entries. Here, since this it was sold for $48,000, you're going to debit the accounts receivable for $48,000, and then you're going to credit your sales revenue account for the $48,000. Okay. Then also remember here, the table cost, each of the tables cost $750 per unit. Let's just go back to that slide here. Sorry. So when you sold 40 of the tables, remember here, the tables, the unit cost was $750 each. Okay, and how did you figure that out? You took the total cost of this job, which is $75,000, and you divided it by the number of units, which is 100. So you came up with a unit cost for the dining room tables of $750 per unit. Okay, so when you sold 40 of those units, 40 of those tables, you're going to multiply the 40 units times the $750 unit cost. And remember, that unit cost is also going to appear on the job cost sheet. Okay, and then here, now finally, when you know what the cost is, you're going to debit the cost of goods sold, okay, which is their income statement account. And you're going to credit the finished goods inventory. Okay, again, transferring the cost from your finished goods inventory to your cost of goods sold, okay, once the sale is completed. Okay, and remember, these two journal entries must be paired with these accounts. Okay, you can't debit accounts receivable and credit finished goods inventory. These amounts reflect, these two amounts reflect profit. These two amounts are based on cost. Okay, so these two accounts must be charged in this way. Okay, good. All right. All right, the last thing that we're going to have to cover in this chapter, and again, it's just going to be an overview, is something that is called activity-based costing. Okay, now, in the United States, we were late to this whole concept of activity-based costing. Okay, and that's why basically remember that in the 1950s, the United States was, our economy was based on manufacturing. Okay, we manufactured autos, bicycles, TVs, everything. That was basically domestic. Okay, and again, since we weren't as automated or as electronically based, we were able to use those historical type of cost drivers, such as direct labor hours, direct labor cost, units produced. Okay, but when competition began, and competition began primarily with Japan. Okay, Japan used much more automated systems than we did in the United States. Okay, so Japan started using a system called activity-based costing. Okay, since they weren't using a lot of direct labor, okay, they were more automated. All right, they didn't want to use the traditional cost drivers. So what was basically happening in Japan and in other countries where manufacturing, like China, also became a forerunner. They used different ways to track their costs. Okay, specifically their manufacturing overhead costs. Okay, so here in under activity-based costing, they're not using the historic cost drivers like as we did. Okay, what they use now in other countries, and now again, even though the United States was slow to get up and running with this, they are getting more online now. The manufacturers that are still based in the United States, the type of cost drivers that they're now using are things such as purchasing and storing materials. Okay, for production, that's the basis, or that's going to be the cost driver. Supervising direct labor. Okay, number of machine runs. Okay, so what activity-based costing did is since the manufacturing processes were really being re-engineered, okay, what happened then is that the cost drivers were re-engineered as well. The traditional cost drivers no longer worked, so they were going to revise the type of cost drivers that are going to be used to apply manufacturing overhead. Okay, and again, the consuming of electricity, the maintenance work on machines, basically the way that manufacturing overhead costs are going to be captured and also applied to jobs is going to be very different. Okay, and we could see that here just looking at the underlying cost drivers that they used. And again, remember that since the United States, the auto industry, the electronics industries, again, if these companies were around for a long period of time, their manufacturing operations were outdated. So it's not enough just to change your cost driver. Okay, you also have to change the underlying operations. Okay, which is a huge financial endeavor. But again, in order to stay in business, this is what companies had to do. Okay, because basically what was happening is in other countries where they had cheaper labor and they also had more automated processes, they were able to manufacture goods much cheaper. Okay, and then based on global competition, it really forced a lot of industries and really the backbone of our economy to change. Okay, so now what all manufacturing companies and even service companies are changing. They're not going with the traditional cost drivers. They're using activity-based costing. And again, you just have to know the definition of activity-based costing, how the cost drivers are different, okay, using this type of cost system, how it's different from the traditional cost systems. Okay, and that's really all you have to know. You just have to know the term, really. And again, there's a whole semester that some of you are going to spend going over that when you're looking and you're studying cost accounting further. Okay, and that is it for this chapter. It was only a partial chapter. Here, and again, activity-based costing, you just subdivide the cost pools into different pools and you use different drivers to apply manufacturing overhead to your jobs. Okay, now if there are no, anybody have any questions? Okay, if there are no questions, then we will go ahead and we will go over the homework for chapter 17. Okay. Now, for the first problem, here, let me just increase this here. For the first problem, I just put the actual wording underneath. This is brief exercise 17.1. So for brief exercise 17.1, here, Taylor Corporation uses a job order costing system. Okay, and allocates manufacturing overhead at a rate of $25 per machine hour. So they're using a traditional cost driver. Okay, during this period, the company used 800 machine hours and actually incurred manufacturing costs of $19,500. Okay, and then here, letter A, prepare a summary journal entry to record manufacturing overhead allocated to the jobs during this period. Okay, so letter A is asking us, what is the amount of applied overhead, okay, to all of the jobs that were ongoing for this particular month? Okay, so again, remember, applied overhead is going to take the predetermined overhead rate of $25. Okay, $25 per direct labor hour. Okay, or I'm sorry, per machine hour. And then here you're told how many, and remember, it's the overhead rate times the actual amount. Okay, so here it's actual machine hours during this month. They had 800 actual machine hours. So the $25 times the 800 hours equals $20,000. Okay, that's the applied overhead. So whenever we apply overhead, we're debiting the work in process inventory, and we're crediting the manufacturing overhead account. Okay. What else are we told here, though? We're also told in the second part here, also prepare a summary journal entry to record actual overhead costs. Okay, so remember, in the manufacturing overhead general ledger, the debits are the actual overhead, the credits are the applied overhead. And we're told here the actual overhead cost for this month equaled $19,500. So here, when you're actually recording the actual overhead, you debit the manufacturing overhead account for the $19,500, and then you credit the various accounts. Now, you know, in accounting, typically you're not going to see something like this, various accounts. Okay, you know you're going to have to give the detail. So here, what would be some of the accounts that would be credited here for the actual overhead? Any ideas? What would be some of the actual accounts that would be credited here when you're recording actual manufacturing overhead? Direct, not direct. Remember, direct labor and direct materials get recorded separately because those are direct costs. Okay. Here it would be things such as salaries expense, right? Right, exactly. So, Kristen, here you would say salaries payable would be credited here. Salaries payable. What else? Accounts payable. Utilities payable. Very good. Okay, those would be the accounts that are being credited here. Okay, factory depreciation. Very good. All right, so let's look at what we have so far. So now we have this manufacturing overhead account, and we know at the end of each month that it has to be zeroed out. So just looking at these journal entries here, we see manufacturing overhead was credited over the course of this month or over the course of this year for $20,000. Okay, and we know that it was basically debited for the actual manufacturing costs of $19,500. Okay, so what does this tell us? Do we have a debit balance in the manufacturing overhead account or a credit balance at the end of this year? Do we have a debit balance or a credit balance at the end of this year in the manufacturing overhead account? Anyone? And this is based on the journal entries that we had here. Okay, we see here, we have a credit. Very good. We have a $500 credit balance. Okay, so when we have a $500 credit balance, what does that mean? That means manufacturing overhead was over applied, right? Manufacturing overhead was over applied by $500 because the actual manufacturing overhead costs were $19,500. Okay. Here though, we charged $20,000 to our jobs in process. Okay, so what do we have to do? Remember, we have to zero out this credit balance at the end of the year. Okay, so what do we do to basically remove this credit balance? What are we going to do? We have to debit the manufacturing overhead account by $500. Okay, now the manufacturing overhead account has a zero balance. And then typically, if it's not a material difference, which account is going to be adjusted? We are just going to credit the cost of goods sold for the $500 then. Okay. And that's C, prepare the journal entry to close the manufacturing overhead account directly to the cost of goods sold at the end of the period or at the end of the year. Okay, that's the only time you will close manufacturing overhead, at the end of the year. Okay, everybody good with that? So that's the typical journal entries for manufacturing overhead that you would have over the course of the year. All right. All right, so let's do exercise 17-2 then. All right, so Curtis Corporation finished job 314 on June 10th, on June 1st. On June 10th, the company sold this job, okay, for $10,000 cash. Okay, total manufacturing cost at the time amounted to $7,000. So here, they're telling us that total manufacturing cost, okay, equal $10,000. Remember, total manufacturing cost consists of direct materials, direct labor, and manufacturing overhead. Okay, so here, record the transfer of this job from the work in process to the finished goods on June 1st. So when the job was completed on June 1st, what did you do? You debited for the cost of the job, remember the $7,000, you debit the finished goods inventory for the $7,000, and you credit or reduce the work in process inventory for the $7,000. Okay, because you're transferring the cost of that job to the finished goods inventory account. Okay, letter B. Letter B says record the sale of this job and transfer the cost from its finished goods on June 10th. So when the job is sold, okay, on June 10th, what is the journal entry to adjust the finished goods inventory? Because remember, when those goods are sold, they're no longer part of the finished goods inventory. So what do? The first journal entry is to adjust your inventory account in a perpetual inventory system. So here you're going to credit your finished goods inventory for the cost of the job, which is $7,000, and you're going to debit the cost of goods sold for $7,000. Okay, because you transfer the cost of that job now to the expense. Okay, but what else do you have to record? Remember, the job was sold for $10,000. So what is the second journal entry in a perpetual inventory system when you sell goods? Now you have to recognize the revenue, okay, or the cash received. So here you're going to debit cash for the $10,000. And you credit the revenue account of sales or sales revenue for the $10,000. Okay, and remember the nice thing about when you're using a perpetual inventory system, you see here how we recognized revenue of $10,000, right? Based on this job, we sold this job for $10,000. We know that the cost of the job was $7,000. So what else do you know when you're preparing this journal entry? You know the gross profit on this job equaled $3,000 as well. So that's a nice thing, okay, when you're using the perpetual inventory system. As you're doing the journal entries, you know the amount of revenue, you know the amount of expense or cost of goods sold that you've basically recognized, and you also recognize the amount of your gross profit as well, because it's the difference between those two amounts. Okay, everybody good? All right, let's go to the next exercise. Okay, so here, brief exercise 17-6. So here we're applying direct labor costs. Okay, so again, we're looking at our direct labor general ledger. And remember, it's going, the direct labor general ledger is always debited for the payroll costs, okay, of direct labor. And then it's going to be credited when these costs are applied to the job. Okay, when you apply the direct labor cost to the job, that's when the direct labor general ledger account is going to be credited. Okay, so here, Needles Company pays its direct labor employees. Now, this is important, okay? I guarantee you that this will be on the final, okay? So this company pays its direct labor employees $20 per hour. That's the hourly wage, Okay, during the current period, 500 direct labor hours were recorded. Okay, on the employee time card, so that's what we could always tell. And the company actually paid its employees $8,500. Okay, so what do we know? We know here, at least now, looking at the direct labor general ledger, we know that they paid their employees $8,500. So that's how much is going to be debited. Okay, we know this already. Okay, so here, record the journal entry to apply direct labor costs to all the jobs during the period. So here, how do we apply the direct labor costs? Again, we're going to take what we have to do first. Since we know actual direct labor paid equals $8,500, okay, we know that $8,500 is the amount of direct labor. Okay, and then what do we have to do? We have to divide that $8,500. Okay, we have to divide it by the hourly rate. Okay, so the hourly rate here is $20 per hour. Okay, I'm sorry, take that back. Okay, so here, the letter A, record the journal entry to apply direct labor costs to all the jobs. How many direct labor hours were charged? We charged 500 direct labor hours. What was the rate of pay? $20 per hour. So how much direct labor was charged to the work in process inventory? How much direct labor was transferred to the work in process inventory? $10,000. Okay, so, and we'll credit that here, the $10,000. All right, so that's the summary journal entry to apply direct labor costs to the ongoing jobs. Okay, letter B, prepare the summary journal entry to record the actual direct labor wages paid during this period. We're told here the direct labor wages in total, the amount paid was $8,500. So here we're going to debit direct labor for $8,500 and credit cash. Remember, because the debit is to payroll. So when we actually pay the payroll, we know we have to pay our employees cash, so cash gets credited. Okay, and this journal entry then records the payment of direct labor wages during the period. But what else do we know here? Okay, so we prepared these two journal entries. What else do we know? We also know that the direct labor general ledger has a $1,500 credit balance. Okay, in it at the end of this month. So what does that $1,500 in as a credit balance basically mean? It basically means that $1,500 of direct labor hours have been applied to the jobs. Okay, however, the employees have not yet been paid. Okay, this is basically the date that these journal entries were recorded is between payroll cycles. Okay, so what does this tell us here? What is the balance, letter C? What is the balance in the direct labor account at the end of the period? We know it's a $1,500 credit balance. What does that credit balance basically signify? It basically signifies that there is $1,500 in wages payable. Okay, this shouldn't be salaries payable. This should be wages payable because it's direct labor. And we know direct labor is always paid wages. So we know now because of the activity in this account that we have a $1,500 balance in the wages payable account on the company's balance sheet. When is that $1,500 credit balance going to be reduced? When is the $1,500 credit balance in the direct labor account going to be reduced? Any suggestions? Okay, we've applied $10,000 to our jobs for this month, okay, to our job cost sheets because that's how much our employees actually worked, but we've only paid them for $8,500. Okay, so when that means we have a $1,500 credit balance in our wages payable account. When is that $1,500 going to be reversed? It's going to be reversed, exactly, Daniel, excellent. On the next pay date, that's when that $1,500 is going to basically be reversed, because then we're going to see our employees getting paid for that $1,500 balance. Excellent. Okay, so always realize that, again, it's not unusual to have a credit balance at the end of the month in the direct labor account. It just means that we've actually incurred direct labor costs and charged it to the ongoing jobs, but it's just that it's the next pay cycle is not until sometime in the next period. So, excellent, Kristen. I didn't see your answer. Yes, and Christian Lee as well. Excellent, on the next payroll day. And Daniel, very good. Okay, so just realize that's not unusual, and it will naturally balance out. Okay, as opposed to our manufacturing overhead account, right? And we know at the end of the year that we actually have to reverse it and zero out that balance. This balance in the direct labor account will just always carry over until the next pay period. Excellent. Okay. All right, very good. So now the next problem is a great example. It really walks through everything that we learned in this chapter. So please pay close attention. We're going to walk through all the journal entries that we talked about. Okay, so here, this is exercise 17.7. Zelda Manufacturing organized in June and recorded the following transactions during the first month of operations. Okay, and it's asking us for the journal entries here. So the first journal entry, when the company purchased materials costing $800,000. Okay, remember, what is that journal entry going to be? It's going to be a debit to the direct materials inventory account and a credit to the accounts payable. So let's look here. Journal entry number 1. Again, they purchased $800 worth of direct materials. And here we see direct materials getting debited $800,000 and accounts payable getting credited for that $800,000. Okay, so we see that first inventory account being increased. All right, standard journal entry. Okay, let's go to number 2. Zelda used direct materials in production, which cost $485,000. Okay, so when direct materials are put into production, okay, remember what has to happen. We are going to transfer the cost to our work in process inventory account for the $485,000 and credit excellent. Excellent, Joshua. Credit the direct materials inventory for the $485,000. Very good. And let's look, is that actually what happens here? And yes, that is what happens here in journal entry number 2. Debit the new inventory account, the work in process, reduce the materials inventory account. Okay, excellent. Let's go to the third journal entry. The third journal entry now, we apply direct labor costs of $500,000 to various jobs. Okay, the journal entry when we're applying overhead to various jobs, again, we are going to be debiting the work in process inventory account, okay, for the $500,000, and we are going to be crediting the direct labor account, okay, for the $500,000 as well. All right, so let's verify that here. Is that what we see happening? And yes, that's what we see happening here. The direct labor is applied. It's being applied to the work in process inventory account, and we're transferring out the $500,000 in labor costs to that to the work in process inventory account. Okay, so standard journal entries we see here happening always. So these are great problems to study from. Okay, number 4, journal entry number 4, applied manufacturing overhead at a rate of $10 per direct labor hours. And here we're told that the direct laborers earn $20 per hour. Okay, so what do we have to do here? All right. Remember, how do we figure out the amount of direct labor hours? Remember that we charged, the total charge for direct labor cost was $500,000, right? We saw that. We saw that. Oh, here we saw the for the direct labor charges, we saw a total of $500,000 being transferred out and being applied. So we're going to take the total direct labor cost of $500,000 and divide it by the hourly rate, which is $20 per hour. We're told that the hourly rate is $20 per hour. So how many hours did the employees actually work? Okay, the 500,000 divided by 20 equals 25,000 direct labor hours. Okay, so here we just had to figure out, we knew the total direct labor cost, but in order to apply manufacturing overhead to direct labor hours, we had to figure out how many direct labor hours there were. So we took the total cost and divided by the $20 rate. Okay, so we figured out now that our employees worked a total of 25,000 direct labor hours, and we multiply it by our predetermined overhead rate. Okay, our predetermined overhead rate of $10 per direct labor hour. So what is that journal entry to apply manufacturing overhead? We debited work in process inventory for $250,000, and we credited manufacturing overhead for the overhead applied of $250,000. Okay, so does everybody see what happened here? Okay, we didn't just charge, we couldn't use the $500,000 because that's a total direct labor cost figure. So to figure out the number of hours, we had to divide probably by the average direct labor rate of $20, which we were given. Okay, and then it came out to 25,000 direct labor hours. Okay. All right. So here, that means the manufacturing overhead, how much was it credited for? It was credited for manufacturing overhead applied of $250,000. Okay. Now the next step, which is number 5. Okay, number 5 basically states incurred actual manufacturing costs of $245,000. And here, again, they're just telling us credit various accounts. Again, typically that's going to be the various payable accounts. So, so here we are debiting manufacturing overhead for the $245,000. Okay, and that's what we see here, manufacturing overhead being debited in this journal entry for the actual cost for $245,000, and we're going to credit the various accounts for $245,000 as well. Okay, and right away we could see that in our manufacturing overhead account we have a $5,000 ending balance, credit balance in this account. Okay, remember this manufacturing overhead account has to equal 0 at year end. Okay, let's go to the next step. What they ask us to do next is number 6, transferred completed jobs costing $745,000 to the finished goods. And remember, this is the control account. So when we transferred costs of $745,000, what was the related journal entry? Again, we transferred the cost for the finished goods to the finished goods inventory. We debited that account for $745,000. Okay, and then what did we credit? We credited the work in process inventory, which reduced that work in process inventory account by the amount of the finished jobs, which is that $745,000. Okay. All right, and then number 7, they sold completed jobs for $1 million. That's the amount of the sales price. Okay, and the cost applied to those jobs was $615,000. All right, so the journal entry here in this instance would be, we sold it, our revenue was $1 million. So we're going to debit the accounts receivable for the $1 million. And then what gets credited here, the sales revenue account or the sales account would be credited for that $1 million. Okay, remember though, we're using a perpetual inventory system here. So what would we do here? We also have to transfer the cost from the finished goods inventory to the cost of goods sold, right? So what is the journal entry here? The second part B of transaction 7, debit the cost of goods sold for $615,000, and we're going to credit the finished goods inventory account. Okay, we're going to see it on the next slide. We're going to credit our finished goods inventory account for that same $615,000. Okay, and what's the nice thing about this? Okay, we know that the difference between the sales revenue of $1 million and the cost of goods sold of $615,000, we could tell on a transaction by transaction basis, we could tell what the gross profit on this sale was, which in this instance, the gross profit is going to be $385,000, which is the difference between $1 million and $615,000. Okay. Remember though, also, we still have to take care of this $5,000 balance in a manufacturing overhead account. Okay, so now we go to the last page in our homework, and here we see the finished goods inventory. That's the second part of that journal entry. Finished goods inventory being credited, and that's to record, that's to reduce the amount of the finished goods inventory. Okay. Now, what step 8 asks us to do is to basically close the manufacturing overhead account. Okay, so remember the manufacturing overhead, it was credited for, the manufacturing overhead account was credited for $485,000. No, this is the $5,000. I'm sorry, here. So the manufacturing overhead account was debited for $245,000, and it was credited for $250,000, meaning that it had a $5,000 credit balance, which was too high, which meant it was over applied by $5,000. So we have to reverse that here. So to reverse that, the credit balance in the manufacturing overhead account, what do we have to do? We have to debit the manufacturing overhead account, right? That zeroes out the balance in that account. And then what's the second part? We have to credit, because it's not a material difference, we have to credit the cost of goods sold for the $5,000. Okay? And that closes the over applied manufacturing overhead account. Okay? Then here, just as the last step, it asks us just to figure out the balances in the cost of goods sold account. All right, so we know here, when we basically debited the cost of goods sold for $615,000, remember when we sold the job and the cost of the job was $615,000. Okay, now it's asking us to figure out what the ending balance in the cost of goods sold is. So here we see we debited it for $615,000, but remember when we closed out the manufacturing overhead account for $5,000, we credited the manufacturing overhead because it was over applied. Okay, so and then we credited the cost of goods sold. So what is the balance in the cost of goods sold account as of June 30th? It's going to be the $615,000 minus the $5,000 adjustment at the end of the month. And so that means our cost of goods sold equals $610,000. Okay, because here we reduced our cost of goods sold for the over applied overhead. Okay, now it asks us what's our balance in our materials inventory account. Again, we were told here that we didn't have any materials inventory previously. Okay, and we know that we debited our materials inventory account for $800,000, right, at the beginning of the month when we purchased a materials inventory. But we know we also transferred out $485,000, right, to a materials inventory to our work in process account. So how much inventory, materials inventory do we have at the end of June? You take the $800,000 debit balance or earlier. Then you subtract out the $485,000 credit adjustment for the direct materials put into work in process. So what is the ending direct material balance on the balance sheet? That's going to appear on the balance sheet, $315,000. Okay, and then finally it asks us the last question, letter C, is determine the company's inventory balances at the end of June. All right, so we just figured out the amount of direct materials, the ending balance, which equals $315,000. Okay, so here, so here it's asking us, we just figured out the direct materials inventory. The other inventory account is going to be the work in process. So here we started out with no work in process, meaning our company most likely just began operations. We know we charged $485,000 of direct materials to our work in process for this year. We know we also charged $500,000 worth of direct labor, okay, to our work in process inventory. All right, and we also know that we applied $250,000, and we get this again from the earlier journal entries. Okay, we know how much was debited to work in process: $485,000 in materials, $500,000 in direct labor, and $250,000 in manufacturing overhead. Okay, what else do we know? We also know that we credited our manufacturing overhead for the $745,000, right, for all the jobs that were completed. So we're going to take those amounts, direct labor, direct material, and manufacturing overhead applied, add those amounts together, subtract out the cost of completed goods, which is $745,000. All right, so what is the ending work in process inventory equal? $490,000. So what's going to appear on the balance sheet as the ending inventory for the work in process? For the materials inventory, $315,000. For the work in process inventory, $490,000. Okay, and that is it for chapter 17. Yes. Okay. Now, what we're going to do is we're going to start, when we meet next time, we're going to start chapter 20. Okay, and chapter 20 is on something called CVP analysis. So chapter 20, that's our last chapter. So we're going into new territory in chapter 20. Okay, in chapter 20, we are going to study something called CVP analysis, or cost volume profit analysis. Okay, again, cost volume profit analysis is part of management accounting. Okay, so we're still continuing with management accounting. Okay, but what we're going to do now with CVP analysis, instead, remember that when we were looking at job order cost sheets, okay, we were basically preparing our income statement, and we were basically dividing costs based on where the cost was incurred, whether it was incurred in the factory and then it was a product cost, or whether the cost was incurred in the administrative areas, which was then considered a period cost. Now, when we look at CVP analysis, okay, we're not going to be looking at where the costs are incurred. We're going to start looking at how costs behave. Okay, how costs behave. Okay, that is, we're going to start analyzing costs based on whether it's a fixed cost, whether it's a variable cost, or whether it's a semi-variable cost. Okay, and that's basically what we're going to be looking at in chapter 20. Okay, so I'm asking you, all of you, please read that chapter before we meet on Thursday. Okay, because we'll be going over that chapter. Chapter 14, okay, Joshua, chapter 14, I'll go over. It's just a couple of minutes, basically. Chapter 14 just basically deals with a couple of ratios. And those ratios, you basically covered them in previous studies. And we're also just going to look at classified balance sheets. And that's basically how you report the information in different ways on the balance sheet. And that's about it. So chapter 14 is a very light chapter, and you just basically have to know what I go over in class. Okay, so you would just scan the beginning of chapter 17 and that's it. And I'll just let you know what specifically you have to know. You don't have to read the whole chapter. Okay, so chapter 20 we'll go over for the next 2 classes, and then chapter 14, and then review, okay, before the midterm. I'm sorry, before the final. Okay, so everybody have a good day. Again, stay healthy, stay happy. Okay, wash your hands, okay? And we will meet again on Thursday. Okay, so everybody have a good day. Okay, you're welcome, Joshua. Thank you, guys. Yes, see you next class. Everybody, please make sure you make it to the next classes.